Worldwide markets this week, effective annual cost, the fee that matters. Oil and Sasol, much ouch. PGMs and gold, FOMC. I'm Simon Brown. This is Worldwide Markets, episode 636 for 25 June, recorded just ahead of market open on Wednesday morning. Worldwide Markets powered by Standard Bank Global Markets and Shift, the global money app, your go-to for travel, shopping, payments, and investments in the palm of your hand, all at the cheapest forex rates. Thanks to Standard Bank and Shift. Remember, you can now get JSE shares on Shift as well as the European American shares on the app. So let's kick off with fees, and a note I want to talk around the EAC, effective annual cost. There are a lot of fees out there. So let's first touch on, if you're going through a stockbroker, this is not applicable. The EAC is if you're going through a LISP or you've got a retirement product, unit trusts on a platform, and usually there is a broker or an agent of sorts sitting between you and the investments. But let's first start with the simple stuff. So you've got a stockbroker account, you're going to pay brokerage. There will be a percentage, there will be minimums, there's then statutory taxes and the like that are added on top, and that's moderately standard. I mean, you'll get different brokers offering different minimums and percentages. That absolutely matters, particularly if you're transacting in smaller amounts, because those minimums can hurt. For example, my platform's 0.5%, but the minimum is 110. So I've got to do a plus 20,000 Rand transaction to get that effective 0.5% minimum. Within funds themselves, and whether they be, these are collective investment schemes. So this will be hedge funds, unit trusts, AMCs, actively managed ETFs themselves, and of course ETNs. With them, you're going to see the TER a lot, total expense ratio. This is how much it costs them to effectively run the fund. That's not the total fee, of course. There's a TIC, total investment cost. The difference between the two is that the TER excludes the actual cost of buying and selling and the like. So that is an added fee on top. TIC is the one you want to look for. But there's also a spread. Say you're buying an ETF and the fair value is $20. There will be a market maker on the sell and buy side. Now that market maker could be selling at 20 Rand and 10 cents. That extra 10 cents is effectively a fee. Another market maker might be selling at 21 Rand in a different ETF. That means instead of paying a 10-cent fee, which is what, 0.5%, you're effectively paying a 1 Rand fee, which is 5%. So that also matters. But what I want to talk today is that EAC, effective annual cost. If you're going, as I said, into a retirement product or a platform and you've got an advisor, there will be a lot of fees. And oftentimes it is very opaque as to what you're actually paying. EAC, effective annual cost, came in about 2017. And this is, it says, this is a standardized measurement so that we can compare apples with apples. What will it include? Well, it will include the TIC, which is the TER plus the investment costs of the product you are investing into, whether it be a Reg 28 retirement fund or a unit trust or whatever it might be. It could even be a unit trust on that particular platform or an ETF. There will be potentially a platform fee. That will also be included in that. There might be an advisor fee. Probably there is if you're going through an advisor. All of that then gets wrapped into that EAC. There might also be other, and I've seen other, and it doesn't ever really tell you what the other is, but it is there, and it is important that we know what that total fee is. And now we've got apples and apples. So you've got one fund, and it's got an EAC of 2.5% and another fund of 1.1%. We've got apples and apples, and that 2.5% fund is charging you a vast amount. An EAC, 1.25%, maybe 1.5% is what you should be looking for. But there is space to negotiate this. Certainly the advisor fee can be negotiated. You can say to the advisor, I want to pay less. The platform fee may be possible to negotiate there. The TER, the TIC, probably less chance to navigate that. So know what your EAC is. That is the number you want to ask for. It is standardized. Some brokers I've heard back say, oh, we can't calculate that. Nonsense. Of course you can. You can't calculate it. What it means is you did calculate it and you realized it's a ridiculous number. So absolutely ask for that if you're shopping around, because ultimately the products that they're offering underneath are broadly the same. A Reg 28, yes, there's going to be some nuances in it, but if you're paying 2.5 versus 1.1, is that fund 1.4% better? Almost certainly not. Almost certainly not. So ask around that. And then there is a bugbear of mine, which is platform fee. Now, I appreciate there's a fee. Now, back in the day, lots of companies didn't charge it. Yes, looking at you, Signia and Easy Equities. Now, suddenly there's that platform/admin fee. And I know with Easy Equities, you can jump through the hoops, but that was not the story that they started on. Aside, your platform fee, it's going to be one of two ways. It's either going to be a flat fee, $100 plus VAT or something, or it's going to be a percentage-based fee. Now, again, depending on your portfolio, if you've only got R1,000 portfolio, $100 a month isn't a giant amount, and you'd much rather pay a 0.1% per month. But as it grows, think of a R1,000,000 portfolio, which is what we're all aiming to get to at some point. Your $100 a month is suddenly quite small. $1,200 a year on R1,000,000 portfolio, it is tiny. But if they're charging you 1% a year on that R1,000,000 portfolio, you're now paying a fair chunk. You're paying 10,000 Rand. And when you grow it to 10 million, you're paying 100,000 Rand. And to be clear, the amount of effort from that platform between a 1 million and a 10 million Rand fund, or a 1,000 and a 1 million Rand fund, there's no extra real cost for them, really. They are ripping you off. You want flat fee. Percentage-based fees are an absolute horror in this industry. So let's touch on oil. I spoke on my MoneyWeb show last week around oil on Friday, and I was looking at it and saying, you know what, this kind of looks like we've got a scenario in which the most likely outcome for oil is probably higher. And then over the weekend, we had the American attacks on Iranian nuclear facilities on Saturday evening, Sunday morning our time. Lots of talk that this was going to push oil up 5, 8, 10% on the Monday morning. And we certainly did see a bit of an uptick in oil. It got to as high as 78, 79, let's call it $79. That's after it closed on Friday at 76.60. So it was only some $2.40 actually higher than the close on Friday. And the logic was quite simple, right? Iran provides 2-3% of global oil. More importantly, the Straits of Hormuz, would they close those? The Iranian parliament allegedly voted to close it. I said in last week's show, if they close those straits, which is around a quarter of global oil, how does that play out? Is that, are we not going to see military action come in and say, no, you're not closing those, and essentially reopen them by force if need be? The point is that Monday's price action really told us a lot. First, the jump wasn't as big. You could argue that it was already into the price. I don't think the US attacking Iranian nuclear assets was into the price. Trump had said on Friday he would make his decision known within 2 weeks, which is classic Trump. Everything's 2 weeks away. Think about his giant healthcare plan. Still haven't seen it. His infrastructure plan. Still haven't seen it. It's always 2 weeks away. But it did suggest to us that, hang on a second, the market is saying, definitely a risk here, but not that much of a risk. Why not that much of a risk? Because there's so much oil. We've got sanctioned oil from Venezuela, sanctioned oil in Iran, sanctioned oil in Russia, and yet that oil is being bought. We know it's being bought. Why? Because of the prices. And they are technically now falling outside of OPEC because they're sanctioned. And, think about Russia. Russia is pumping as much oil as they can. They don't care about OPEC limits and the like, in their case, OPEC plus, because they just want and need that revenue. We've seen OPEC Plus doing production increases during the course of 2025 and late 2024. And so what's happening out there is a lot more oil coming into the market. And as I said, price action on Monday said to you, this oil worry is overstated. Like, there seems to be a lot out there. Then, of course, peace got announced Tuesday morning, T's and C's, whether it's been violated by both parties seemingly. But nonetheless, oil then absolutely cratered. And as I'm recording this on Wednesday morning, 67.70, more than $10 down. I've actually got a high for this week. The high was 81.40. So it opened at 79, but it jumped to 81.40 on Monday. And now we're down at 67. That is a $14 fall in oil. That is close on 20%. That is absolutely giant. The world is awash with oil. It absolutely is. And it's going to get more awash with oil because more OPEC plus increases, production increases kicking in July, and global GDP slowing because of tariffs and other bits. So no surprises there whatsoever. I think it's going back to $60. Absolutely. And then we will see where from there on down. We've been sub 60 already this year. This, of course, is what we could say very bad news for Sasol. Now, reports are that we've been seeing some institutions buying into Sasol. Fair enough. We can see it was 3 weeks ago that we saw Sasol rush up and get to that 100. I spoke about stale bulls at the time. I said 100 was going to be hard. It kind of got there or there's about 3 times, including on Monday. But Tuesday was a horror show. I think Sasol was down 14 or 15%. It's now down 80.96. Haven't opened for Wednesday yet. The support level is currently sitting at around 77. And if that holds, we are back to sort of 60 or sub 60. Sasol's got many problems. Oil price is definitely one of them. We've got a stronger rand. We'll look at that in a moment. And of course, chemical prices aren't helping. Sasol is in pain. It's not going bust or anything like that. But look, I've never been on the Sasol bus. I've always been saying thanks, but not for me. What we are seeing is the rand, which again told an absolutely wild story. So last week the rand was out at 18.15. Monday the rand was trading out at 18.15, and now we're down at 17.76. This is in large part dollar weakness. Absolutely it is. But of course it is not helping the likes of Sasol, who want to sell their products in dollars. And I still think that, the 1780, which was my immediate target for rand, is now gone. That has been absolutely tagged. $17. I think we can do 17 on the rand. We totally can. Let's look at the FOMC. So we had the FOMC meeting last Wednesday evening. No change as expected. Jerome Powell then testified to Congress yesterday, Tuesday afternoon. And what he and his committee members, and to be clear, the no change was unanimous. And he's getting a lot of hate from MAGAs, like, why did you cut ahead of the election? The inflation rate is looking better now. Yes, the inflation rate is looking better, but the outlook is not. The census, the dot plots, and what we're hearing from FOMC members is that they still anticipate 2 more cuts this year. I need to quickly look. We've got meetings end of July, September, and then October, and then in December. So there's still expectations for 2 more cuts. But if you look at the data that the Fed puts out, GDP, they're expecting it to be lower. Inflation, they're expecting it to be higher. Unemployment, they're expecting it to be higher. They are playing the data game. And there's a bunch of FinTwits, South African FinTwits, who are suddenly hating on Powell and calling him anti-Trump and stuff. No, man, he's just doing what central banks do, which is look at the data and typically be cautious. That is what they do. And what you'd rather be is maybe, you don't want to be behind the curve. Absolutely not. But to be very clear, Powell is not behind any curve at this point in time. I would argue that our MPC is behind the curve. We've been cutting local rates far too slowly, but that's another story in its entirety. I think our MPC, and maybe the talk now is all about the moving to 3% inflation target, which at current rates of 2.8 on inflation means that largely, well, then you don't cut because you're pretty much at the point. Let's have a quick peek at PGMs. I was chatting with Old Mutual Investment Group on my MoneyWeb show on Tuesday morning. They are lightening gold and moving into PGMs. So look, the gold story is not over, but they don't think we're going to get the sort of move we saw in 2001, 2008. Those moves, when I spoke to them early in the year, then was forecasting a $4,500 more or less gold price. They're saying, but this is the a platinum chart. Platinum is looking really strong. It's broken higher. It's held it. And on the weekly candles, we're moving up and up. Now, we don't have a weekly candle, a new high on this week, but it's only early Wednesday morning. We have got platinum trading at more than 10-year highs. I have to zoom out a whole bunch more. We've got platinum trading back at levels last seen in October 2014. So let's call that, it's about 11 odd year highs. And of course, the PGMs are loving it. Palladium, a little less thrilling in that regard. Turns out I can't spell palladium so good. But palladium has been running, but we've got a totally different picture here. Palladium's basically stalling at that sort of 1,060, 1,070 resistance. There's another resistance up at about 1,235. And there's a key distinction between palladium and platinum. So South Africa, mostly platinum, or Southern Africa, Zimbabwe's in that as well. Palladium then mostly coming from Canada and Russia. And there was a lot of stockpiling when the Russia invasion of Ukraine some 3 odd years ago, and platinum obviously less so. But there is a platinum deficit according to the World Platinum Council. And that deficit is quite simple. We're seeing less production come out of the mines. They are shuttering some shafts and doing less mining because they don't like where the price points are. But there's also a story around electric vehicles. The thinking was that by 2035, EVs would be about 60% of new vehicle sales, and that's been pulled back to around 40%. I'm not going to delve too deep in. I'm actually going to do a whole show on that separately. But that does mean that the existential crisis for PGMs is either less existential or perhaps sort of kicked down the road and left to a much further date. So we certainly are seeing the PGMs run. The question, folks, everyone is like, which is the preferred PGM? I mean, pick your poison. Volterra is certainly well liked. Implats, Northam. I mean, they're all going to broadly do the same sort of thing. There's, of course, also Sibanye Stillwater. They have got lots of gold and they've got lots of palladium because of their North American operations and a lot of recycling. We're not seeing a lot of recycling. At current price points, recycling that catalytic converter, just not really worth it. So then let's have a quick last peek at gold. Gold is coming back, and this morning we're seeing a little more weakness down at 3,330 as I'm chatting. Certainly that has come down from the peaks. What did we get? We got a 3,495 in the last week of April. But it's just coming back into my support box. So, maybe as low as 3,200. If that holds, we're in biz. If not, then it's back to that sort of 3,000, which I've been talking about for a bit. But, it broke out of the box. It's coming back into the box. At this point, I don't see this as a sort of gold rolling over by any stretch of imagination. And I don't think we did the power hour last week. You can find that justonelap.com/power hour talking around gold. I think there's been a structural change in terms of gold and how it's viewed by the investment world. I was making a point in the power hour last week, not for South Africans, but for people in developed economies. The inflation that we saw during the pandemic was the first time at those sort of levels since the 80s. In other words, people had never experienced that level of inflation. And neither had the central banks and the like. And there's been a fundamental mind shift towards gold. Part of that as well is the confiscation of Russian dollar central bank assets when the war broke out. And I've said before, central banks are suddenly saying, you know what, maybe we need a little more gold, in essence, to protect ourselves. Worldwide markets powered by Standard Bank Global Markets and Shift, the global money app, your go-to for travel, shopping, payments, and investments in the palm of your hand, all at the cheapest Forex rates. Huge thanks to Standard Bank. Huge thanks to Shift for sponsoring the show. We'll leave this week's show here. As always, we'll be back again next week. My name is Simon. Look after yourself. And if you can, look after somebody else as well. Cheers all.